So as to the concerns regarding the partnership that Actis has with CDC as a government stakeholders, as a UK government partner, they are ultimately liable to them, which means that CDC can still put pressure to remove or to make changes in management if they don't deliver. Or they can just pull out the money at the end of a term of a fund. Actis also has to make the argument clear to the UK government that private equity is an important tool to build the sustainable growth in those emerging economies, and an effective tool in reducing poverty in those countries where traditionally foreign aid has been the main tool to leave those countries out of poverty. Also, while the emerging market funds are still considered risky because of all the factors that we mentioned earlier, and they don't have the sheer quantity of investment opportunities to be able to deliver the profits, the financial profits that private equity investors expect. It is expected that investments in these countries will grow increasingly more and more as the profits in the developed economies decrease because of the macroeconomic conditions.
So as we're raising funds for some of the 5 markets that we committed to and we talked about earlier, like the Africa Fund and the South Asia Fund and China Fund, some purely financial investors might not be interested in participating. Basically, the argument is that right now there are still other more attractive opportunities, even in the US and Europe, where a lot of investors that are looking to invest their funds in private equity can get a higher guaranteed return for lower risk than investing in some of our funds that we haven't proven. So therefore, Actis is probably going to need to attract more mixed agenda investors who are looking for returns beyond purely financial gains. So we're, foundations, universities, and regional funds, for example. Also, illiquidity is going to be a main factor that will keep private equity out for most of our funds, because even though we might promise a higher return, I don't think that we have Actis doesn't have the track record to really credibly deliver on that promise. And 10 years is a long time to commit money to sort of an uncertain fund prospect for many of these pure value investors. However, Actis could have a way to cater to different types of investors, and so although they can't just create pure regional funds, such as a South Africa fund that would, or Sub-Saharan Africa fund that would attract pure value investors, they could sort of carve out different funds that are more specific. So Sub-Saharan Africa funds could be attracted to mixed agenda investors, and Actis could have an edge in that market because it has 40 years of experience investing in those countries. So they do have a credible argument on why their return would be higher than other players in private equity. But they also would be able to deliver some social returns, also based on their experience with the government there, that would be attractive to mixed agenda investors. And then funds that focus on India, China, and Brazil, or portfolios such as telecoms or their energy business or their agribusiness that have proven returns, could be sort of marketed out to pure value investors. And again, the Social Investment Forum is a perfect example of a mixed agenda investor that might be attracted in either of those funds. And so Actis could also make the argument that the emerging market is going to be better to get a head start by investing in these markets, and thus basically if people don't start investing in Sub-Saharan Africa, for example, they're never going to build up the continent to get those 30% returns that they're going to demand. And so it's better, especially for the mixed agenda investors, to invest now, because they're still going to see some financial returns, but they're also going to build economic growth in these countries, which will alleviate things like poverty. But also, if they're kind of looking for future returns, then they'll already have a relationship with Actis to invest 10, 20 years down the line when the countries are more primed for that sustainable large returns that we only see in the US and Europe. So our recommendation, which is kind of premised by all the previous slides, is that Actis they shouldn't go out and try to pursue those pure value investors, because even though they have this governance structure right now that's just separate than it was from CDC, where it's like private partners now on the company, they have a profit incentive to seek those 30% returns. We think that that's not going to be very successful, because if they go out and raise money on the basis that they'll be able to return that high of a percentage, there's a high likelihood that they'll fail, and that's not going to lead to the long-term sustainability of the business, and can hold actually some risk for all private equity investment in Africa, because Actis is sort of looked at as the leader of these or the leader in investing in Africa and some parts of Asia. So they don't want to create a lack of confidence in those investments. So therefore, it should really prioritize its CDC funds, which allow it to invest in companies that might not be as profitable as the ones primarily in China or India. So it can really focus on the regions that are the poorest and the companies that really need a lot of support to get off the ground to provide growth. And also it will be able to, when we are raising the third-party funds for those 5 funds that we mentioned, the mixed agenda investors will be the ones to focus on. And those investors will see as much of a return as if they would have spent their money just investing in food aid or all these other programs that are the typical remedies for problems in the most impoverished part of the world, and they'll get to see an actual return on it. It just won't be a grant expenditure. So they'll get to build up businesses in these countries, promote jobs, promote infrastructure development, and also be able to generate some return for future projects. And over time, in the next 10, 20, 30 years, Actis is going to be able, after it develops more of the companies in these markets and encourages good rules of law and transitions in these countries and companies that allow for more complicated types of investments, then they'll be able to go after the pure value investors. And we think that that's the long-term strategy for Actis. It just would be too soon to realize it now, especially when it has all this money just sitting in the bank that it needs to put into profitable investments, or even investments that break even. And so we think that Actis should wait to attract pure value investors. But overall, we see the future as bright, and that kind of the question raised by the case was, should Actis exist in its current form at all? And we believe that it should, and that actually the status quo is pretty much the right track for Actis to continue, at least over the next 10 years as it develops its funds. We'd like to thank you for listening to our presentation, and we hope you find it informative.